In this discussion, we will discuss the discussion question of explain what horizontal analysis is and how it can be useful. If you see a discussion question or essay question such as this, our goal often is to add more information to it if time allows that, giving us more ability or possibility of being able to touch on the information that's being looked for within an essay question and adding to the discussion new information which is often necessary or is what is being looked for with regards to a discussion question. Keeping that in mind, let's go through this one more time. Explain what horizontal analysis is and how it can be calculated. So when we see something like this, we might want to take a step back. One way to add information to something like this to say, all right, horizontal analysis, what is that used for? What is it? And then why would that be used? Who's it useful to? What's the purpose of this thing? So we have horizontal analysis. We could take a step back and say, well, that sounds like some type of analysis of financial statements. So this is financial statement type of analysis of some kind. We could take a step back from that and say, okay, well, who would be using financial statement analysis? It could be internal users. It could be external users. And then we can go into detail there. We could start there and say, well, so financial statement analysis could include something like horizontal analysis, and it could be used by both internal and external users. Internal users could be management that might be using the horizontal analysis as a form of financial statement analysis in order to get better information about the financial statements for decision-making purposes. External users might be using the horizontal analysis such as creditors or such as potential investors use horizontal analysis as a form of financial statement analysis to see if they want to do business with the company. And you can go into detail about that information. And then you can say, okay, horizontal analysis is a component of financial statement analysis, which generally includes like three categories, horizontal analysis, vertical analysis, ratio analysis. So it's one of our categories of analysis. You can go into the other categories if you so choose as basically relatives or relationships to the horizontal analysis. And then you can talk a little bit of what is financial statement analysis. Financial statement analysis is going to be something that helps us to get insight into the performance of the company. So we have the financial statement analysis to get insight to the company, the horizontal analysis being one of the things that can be used to get insight to the company for managerial accountants, for the internal users, for better decision-making purposes, for external users, investors, creditors, to try to see if they want to do business with the company. So once we have that broken down, we can say, okay, now horizontal analysis is going to be one of our major components. What that's going to do, that type of analysis, is be taking the financial statements, typically the balance sheet and the income statement, comparing one year to another year, or one period to another year, one period to another period, which could be years, could be something other than years. We're typically thinking about years. We'll often call the early year something like the base year, and calculate the second year and the first year, doing a comparison. It's important to note that the horizontal analysis is going to be something that usually is going to be compared for one company over time. So we're usually comparing one company over time, and we can go into then the calculation of it. How would it be calculated? Well, we're going to have the current year number minus the prior year number for each account, and that will give us the difference in dollars. And this would be the most straightforward type of thing most people would think of if you're trying to say, hey, how are we doing? How are we doing with our financial statements? Well, the first thing you'd probably do is say, well, I don't know, let's line up the financial statements this year, balance sheet, income statement, all the accounts. Let's line up the balance sheet and income statement accounts from the last year, and then let's subtract the two and see if we're better or worse off. For example, what's our cash this year? What's our cash last year? What's the difference between the two? Did it go up or down? What's our sales this year? What's our sales last year? What's the difference between the two? Are we selling more or less? What's our net income this year? What's our net income last year? Did it go up or down? Are we have better off in terms of net income this year versus last year? That dollar change, probably the first thing we would think about when we start to think about our performance over time with regards to two sets of financial statement, 2 sets of years. Now, we're going to take it a step further than that with a ratio, and the ratio is going to help us to be able to compare what we have in our books oftentimes to other types of areas, such as competitors, such as the industry in total, or basically general standards in some way, because we can't compare oftentimes our dollar changes because the other competitors are going to have different ranges of dollar amounts. So they may be a bigger company than we are, but we want to benchmark to them because we look up to the bigger company, or we want we want to be bigger too, you know? So we're gonna try to use their information. We can't use their information with just a dollar change. We can use their information with a percentage change, because we can hopefully get some more insights about our performance with relation to theirs with a percentage change that we cannot get with a dollar change. How do we calculate the percentage change? Let's pick an account. Let's do a calculation. Let's say we're talking about sales. We're going to take the dollar sales of the current period minus the dollar sales of the prior period, which we can call the base period. That's the dollar difference. That's the change in terms of total dollars. We're going to take that amount. We're going to divide it by the prior period, the base period. That gives us the percentage change. In other words, the percentage increase, the percentage decrease. Same thing you kind of think of when we see sports statistics and whatnot. You know, the batting average went up by this percentage or that percentage. Why do they use percentage? Why don't they just say they got this many more hits this year than last year? Because we need to compare it to the number of hits in order so that we can compare it to their prior performance and to other industries. So we need to have that kind of percentage. Same type of thing. We could do that for all balance sheet accounts, all income statement accounts, and get that type of horizontal analysis. Now note that another type of analysis that's related, it's similar, that's going to be compared period to period, is a trend analysis, which is kind of a type of horizontal analysis, but because it does compare things over time. However, it's a little bit different because we're not comparing just two periods. We're comparing multiple periods to a base period. So for example, if we had 4 periods that we're thinking about, we'll do the same thing. We can line them up. We're just going to line them all up. But this time we can't take the difference because we have 4 periods. I can't take the dollar change between 4 periods because we have more than 2 periods. So what we're going to do is we're going to compare everything to the base period, and that's going to be a little bit different, but still a type of trend analysis that's going to happen over time. So for example, in year 4, we'll pick an account. We'll pick cost of goods sold. We'll take the current cost of goods sold and divide it by the base period, possibly the first of the 4 years being the base period. In year 3, we'll take the cost of goods sold for the year 3 and divide it by the base period. And so that's going to be the type of calculation, everything being compared to the base period. And the reason we want to do that, it might give us a nice trend to see what the actual trend is by having everything compared to a single set point, a single base.